Welcome to another episode of Equity Mates. It is Watchlist Wednesday, one of our favorite episodes of the week. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going?
I'm very good, Bryce. Happy Wednesday.
Thank you.
Best way to get through the middle of the week is to listen to an expert talk about 3 stocks on their watch list.
Love it, love it.
And we've got a new expert for the Equity Mates community here today.
We do. It is our absolute pleasure to welcome Rob Shears to Equity Mates here at AusBiz. Rob, welcome.
Thank you very much for having me.
So Rob is the founder at Valor Financial Group, and we have 3 big hitting stocks on the watch list this week, which we're very excited to get into. So we may as well kick off, Rob, with your first stock pick, a company that I'm sure many Equity Mates community members will have heard, and one that has never been pitched before, and that is Berkshire Hathaway. So firstly, what is it for those that haven't heard of it, and why is it on your watch list?
So Berkshire Hathaway, most people know that that's Warren Buffett's holding company. It's predominantly an insurance company, but it's becoming less and less insurance over time as the subsidiary businesses grow larger than the rest of the insurance business. It's got about somewhere between 80 and 130, depending on how many subsidiaries you want to count in the subsidiaries, different businesses, and I think it may be the best business in the entire world. I know that's a big call.
And so what is it about Berkshire that, has it on your watch list? Huge company. We can get into underperformance in a sec, but yeah, what's the thesis?
So the thesis is that it's one of the best companies in the world in an undemanding valuation. So over the last, since 1982, Berkshire Hathaway has never traded below book value. And in the post-1982 era, it's traded between 1 times book value and 3 times book value. And obviously the book value becomes less relevant as it grows subsidiary businesses which are not listed. But it's trading at 1.38 times book value today, so it's actually below its long-term average in a market which is, there's no one saying that we're below long-term average in the market, whereas Berkshire Hathaway is below its long-term average. So it's actually cheap in an expensive market, which is quite a rare beast.
Rob, 2 reasons are probably most given for why it might be cheap at the moment. The first one is the question of succession planning and Todd and Ted taking over from Warren and Charlie. And then the second one is that in an era of high-flying growth stocks, especially the tech sector, Warren hasn't invested in a lot of those companies outside of Apple, obviously. How do you think about those 2 questions?
Yeah, look, I think that the underperformance is, it's moderate over the last 10 to 15 years. It's not significant. But if you look at Berkshire, it usually does better in weaker markets. We're just not in a weaker market. So if the market went down 30 to 50% over the next 3 to 5 years, I would suspect that Berkshire does materially better, and the returns in 5 years' time would probably be normalised to the point where maybe Berkshire's actually outperformed the S&P over that period of time. So it depends on where you are in the cycle, where you look at Berkshire. If you're looking at the top of the cycle, it's probably going to underperform. If you look at the bottom of the cycle, I think that the very instructive period is the dot-com bubble. And if you look at March 2000, possibly the worst time to buy stocks in history apart from today, the NASDAQ went down 78%, the S&P went down 43% over nearly 3 years. And in that same time period, Berkshire Hathaway went up 66% when the NASDAQ went down 78%. So yeah, you can quote statistics at certain time periods, but it depends on when you're quoting them.
Well, Rob, we could talk Berkshire all day, but unfortunately we don't have the time. So let's move to the second stock on your watch list, which is one that I'm sure everyone in the Equity Mates community has heard of and has used, and that is Alphabet. So briefly, why do you like the company and why is it on your watch list?
So Alphabet, it's one of the best companies in the world once again. And I like to do the simple things right. So Berkshire and Alphabet are the simple things. But Alphabet is more than just Google. It's Android, which is outside of the US and Australia and the Western world. It's just the most dominant phone system by a very large margin. About 80% of all phones are Android phones. So it's Android, it's Google Maps, it's Gmail, it's and the big one, the big two which are growing right now are YouTube, which grew at 83% year on year, which is just a spectacular growth from their revenues, and Google Cloud, which is the sort of third major player in the infrastructure cloud department. People just establishing their entire businesses on these systems. So very sticky revenues there. So it's a very diversified business. It's a fantastic business.
It is just a phenomenal business. Obviously, I think it's got like 96% market share in search. YouTube is dominant. So many of its other apps are dominant. Really, the only question becomes the regulatory risk. There's obviously a lot of noise in the US at the moment around breaking up big tech. How do you think about that risk, and how does that weigh on your investing decisions?
Look, it's a very interesting problem to think about. The best way to think about it is that if you look at the individual components of Alphabet, if you put them all as listed companies, they're worth more than the whole. So I think if they did break up Alphabet, there's a reasonable probability that the share price or the total share prices go up, not down. So in the short term, the regulatory risk can certainly take a bit of shine off the share price. But I think that if they did break up big tech, you might actually make money out of that and not lose money.
So Rob, I think there's a lot of great and perhaps not so sexy parts of Google or Alphabet. But the sexy part, the really exciting part, is their investments in self-driving cars. That's the thing that gets me really excited. It's one of their many moonshots. How's that business division going? They've recently reported their results. Do you put much weight into that being a future area of growth for them?
It's a potentially enormous area for growth. About 2 years ago, there was a report released by one of the large consulting agencies which suggested that Waymo, which is their driverless car business, could be 2/3 of all driverless cars in the world within a decade. The problems for fully autonomous driving are greater than most people can understand. It's the last 1%, which is 999% of the equation. So it is. It's more difficult than most people realise. Will they get there within the next 5 years, 10 years? They ordered 72,000 cars 2 years ago, but they haven't really rolled it out in the way that a lot of people are expecting. Most people don't know that Waymo is actually already released to the public in Phoenix right now. So if you go to Phoenix, not that we can go anywhere right now, but if you went to Phoenix right now, you can download the Waymo app, and a car will turn up with no driver and drive you to most places in Phoenix, which is truly extraordinary. But they haven't really rolled that out on a large basis yet because there's issues. There's the snow. There's very, very heavy weather. There's also the regulatory issues, which a car company can choose who dies in an accident, and that's problematic. If you have a choice between crashing into the telegraph pole or running over the kid running across the road, the car has enough decision-making capacity to choose that, whereas a human just unfortunately can't swerve in time. There's a 2-second reaction time for most people, so they don't have a choice. So there's a lot of problems with regulatory, who chooses in those scenarios, and they're going to pre-choose those things, which is just something which boggles the mind.
So Rob, 2 big stocks over in the States, Berkshire and Alphabet, and your third is back home here in Australia, a company that Ren and I often speak about on the show, so love to see it. That is Magellan Financial Group. So what's the thesis? Why do you have Magellan on your watch list?
So Magellan has had a shocker of a year, and usually the best time to buy straw hats in winter. So it's a pretty tough time for Magellan at the moment. They made, I think, 13.9% when the market went up 32% in the last 12 months for their Magellan Global Fund, which is their main fund. So they've had a pretty significant outperformance in the last 12 months. Once again, they do better in bad times than everyone else. So this is not necessarily a problem, but it does mean the shares have come off from their highs. And if you look at the underlying valuation of Magellan, take out the 880 million of subsidiary businesses which are not required to run the business. They have other investments. They've got their fund managers businesses they actually invest in themselves, and they also own Barrenjoey and a couple other businesses. Guzman and Gomez, I keep on donating to their cause. It's becoming a diversified holding company. The part which is the diversified holding company, take that off the equation, and it's only 15 times earnings, so it's not expensive. They just hit $117 billion under management. They announced that this morning. So it's still growing, and we think that they're going to keep on growing over the next 5 or 10 years, sending all the excess cash into the subsidiary diversified holding company businesses, and it'll be a wonderful business and a less dependent business on the fund management business in 10 years' time.
It is a fascinating story that Magellan are building over there. They've got $117 billion in funds under management. They get the fees from that every year, and they use that to invest in a wide array of businesses. You mentioned a couple there, Guzman and Gomez. I think they put $50 million in. Barrenjoey, the investment bank. Can you, for people who are maybe less familiar with that part of the Magellan story and only really think about Magellan as a fund manager, can you maybe talk about that side of the business and the story that's sort of growing there?
Yeah, so look, on the Barrenjoey front, I think that's potentially a very substantial business. They are poaching all the best people in investment banking, and investment banking is who has the best people wins. So they are building out a potentially very substantial business there. By collecting great people. So that has a lot of potential. It'll take a while. There's going to be likely quite decent losses from that business for a number of years before it scales. But once it scales, you look at the investment businesses around the world, and these things are a license to print money in the good years and can be pretty tough in the bad years. They're cyclical businesses, but and we're in the good years right now. So the investment bank is having a great time of the sales like Afterpay, etc. So that's who's winning in this market is the investment bankers. So over 10 years, I suspect that will be a potentially a meaningful part of the Australian investment banking sector. So that could be a significant business in itself. I think there's going to be a lot more of the Guzman and Gomez type. Just they own 10% of, I believe it's 10% of Guzman and Gomez. There's going to be a lot more of those sort of additions to the portfolio. These things are tiny compared to the total value of Magellan, but they will each year add another 5 or 10% to the business, and in 10 years' time, it'll probably I suspect it'll be, if not near half, potentially over half the business will be these diversified, and it's going to be whatever businesses they find, they're going to add in. They're going to be random, they're going to be beautiful, and they're going to be great businesses in their own right, but they won't have any correlation. And that's kind of what Berkshire Hathaway has done over the last 57 years. So if you owned Berkshire Hathaway throughout the between the 1970s and the 2000s, you compounded money at 20-something% because they kept on reinvesting their capital. And probably the most important lesson I've learned over the last, I've been doing this for 16 years professionally and investing for about 24 years now, is that if you're going to own a business for the very long term, it's not what the business does, which is more important. It's the people reallocating the capital. So if you own a business for 20 years, it's the capital which is reinvested, which actually is potentially more important than what the business does today. And the perfect example is Berkshire Hathaway. Berkshire Hathaway used to be a textile mill, and then they reinvested those cash flows into other things, and there's no more textile mill. So it's the management and the reinvestment of the capital, which is probably the largest part of the equation. I've underestimated that in my earlier years.
Well, Rob, I think you've made a big friend in Hamish Douglas comparing him to Warren Buffett. I'm sure he appreciates that.
Well, I think it might be Brett Cairns. It's Brett Cairns is actually allocating the capital. So,
well, there you go. Hamish is not. Greg is, so he'll appreciate that. But look, Rob, we have run out of time, but we want to say a massive thank you for joining us today. Hopefully, we can see you again soon.
Yeah, thanks, Rob.
Thanks very much for having me. I really appreciate it.
Well, that brings us to the end of today's Watchlist Wednesday. A reminder, we had Berkshire Hathaway, Alphabet and Magellan Financial Group, three massive companies that, I mean, you know, you should definitely keep an eye on. So a reminder that this is not a buy, hold or sell recommendation, purely just an exploration of stocks to give you some ideas. So yeah, really enjoyable, and we'll see everyone tomorrow, Ren.
Yep, sounds good.